whatever we add to the program is also added to existing clients as well as new. And it really has afforded us a great opportunity to establish some really great relationships with leaders in the space.
All right, welcome to CBS Spotlight. If you are here by mistake, you are in the right place now. I am Michael Kohrmann.
And I'm Eric Alvarado.
And we are your friendly guides through this world of insurance and wealth management. But today we are joined by the head of behavioral insurance activation at John Hancock, Matt Gibson himself. Matt, thank you very much for joining us today. Did I miss anything?
Yes.
No, I mean, I will go ahead actually and start with the question that I'm sure a lot of folks are probably asking themselves, which is, what is behavioral insurance? And it's actually a really common question that I receive. It's not a typical pairing of words you see in someone's title, but to understand, it's important to take a quick step back, right? Like at John Hancock, we fundamentally believe about helping customers live longer, healthier, and better lives, because it makes sense that a life insurer would want their client base to live a long time, right?
Absolutely.
So if we can create opportunities to encourage, reward, and incentivize those behaviors, here I'm going here, linked to longevity with our clients, why wouldn't we do that? It just makes a lot of sense when you think about it rather pragmatically from that approach.
Very well said. I won't even quip words about it. Eric, do you want to start us off?
Yeah, I mean, we've been hearing a lot of new information about health screening techniques and data coming out about wearable health devices like smartwatches, things like that. Can you walk us through some of the new methods and data that you guys have seen that's come out, I guess, and that's the impact that it's having?
Yeah, so I think technology has come a long way, or even just after the last few years alone, I think particularly in the health and the personal health space. So obviously, Apple Watch dominates the wearable space with actually a Statista survey from 2023, with them controlling about 59% of the wearable market, right? So then the balance is made up by, Garmin, Fitbit, Whoop, Aura, and the like. But one of the things that's really interesting in that space is they've really innovated and brought more things beyond just simply steps, which I think a lot of people first think about when they think about wearable health devices. So Apple introduced, ways to detect atrial fibrillation and irregular heartbeats earlier, which obviously can help find those serious health problems. And I think it goes beyond, like, to your point about other screening techniques, right? So there's also then material advances in those screening technologies. So one example of that is Grail's Gallery test. So for those folks who may be listening who are unfamiliar, the Gallery test is a simple blood draw that looks for a common signal among cancers. So it's not a test or looking for elevated risk of cancer, like a BRCA test, for example. It's actually looking for the presence and the location of an active cancer within the body. So now many people think, we're looking for a cancer specifically. And that's true. We are, like, we do that day to day with the existing screenings. But that's where I think these new screenings really separate themselves from the pack, right? Because there's only 5 screenings that we traditionally do, right? Colonoscopy, prostate for men, breast and cervical if you're a female, and a contrast CT for lung cancer if you were a former smoker. Now, statistically speaking, these aren't the cancers that you're likely to die from. It's the other ones that we're not looking for that are likely to be found typically at a later stage where they're much more complicated and difficult to treat. The American Cancer Society roughly cites that about 70% of cancer deaths are from cancers that we don't have recommended screenings from. So with this in mind, expanding the technology that we use for screenings to find cancers early when they're treatable is really critical. And obviously, as a life insurer, it's a big part of our business.
Yeah, absolutely.
How many cancers are being screened when they do that test?
So they can detect up to a little under 50. But what's really interesting about the Gallery test is that what it's good for are the ones that are the most deadly. So the way the test itself functions is it's looking for that common signal that is in the DNA that's shed by the dead cancer cells that are naturally being shed into the blood. So faster growing cancers, more aggressive cancers, obviously are shedding more and more of that DNA that the test is looking for into the bloodstream. Whereas more slower growing or indolent cancers, it's less likely to find because there isn't that much of the DNA floating in the bloodstream. So it's actually really good at finding the ones that are super, super dangerous, like pancreatic, for example.
Interesting.
Wow. Well, I appreciate that, Matt. How does all of this tie into longevity?
So let's harken back to what I said at the front, right? As a life insurer, who else besides your immediate friends and family would have that much of a vested interest in you living as long as you possibly can? Now, of course, as the consumer, I want to live a long time and a healthy life and a better life.
Right.
But it creates this rare moment where you kind of have this virtuous cycle, right? So if we can create incentives to drive better health behavior, that then yields increased kind of mortality savings to us as the carrier. Now, where the magic happens is if you take the bulk of that mortality savings and use it to fund incentives and other aspects to drive future healthier behaviors, you've now created this kind of like self-fulfilling wheel that works in that. So take the Gallery test as an example. It retails just under $1,000, rather expensive test standalone, but we've made the test available to John Hancock Vitality customers, so aged 50 plus or aged 40 to 49 if they have certain increased risks for cancer, at no cost for death benefits in excess of $500,000, and then a 50% subsidization if it's under $500,000. So it makes a lot. So that's where the finances really just make sense, right? Because if we can create these incentives and drive that behavior, obviously early cancer detection has a clear line towards mortality improvement, right? So we've depending on how you want to look at it, fortunately, unfortunately, we've had multiple customers find an otherwise unaware cancer that they've had. And we've actually had a few of them even step forward to share their story. So there's this one gentleman, Kelly.
Wow.
He came forward and shared his story of finding a early stage breast cancer. Now, keep in mind, he's a gentleman. He's a man.
He's not going to be getting a mammogram.
Odds are he wouldn't have had a mammogram or found it in the absence of this type of technology being integrated into the financial solution that he ultimately purchased. Now, perhaps maybe I should say he would have probably found it, but would it have been still within the time frame where it would have been treatable?
When is the question?
Yeah. And cancer is a tough one, right? Because every single person listening to this recording has been, unfortunately, probably touched by cancer in some capacity of their life. So I use the Gallery test as the example because it's immediately relatable to everyone listening, because we all know the first question that you ask when you hear cancer diagnosis is, what if we got it earlier? What would the treatment have looked like? Would Nana still be with us? Like whatever it happens to be, right? So it's a very deeply personal component for everybody, but there's a direct tie into longevity if you were just aware. And that's part of the things that we do. We don't say, hey, you have to take this test. It's, hey, we're making this test available to you. It's entirely up to you if you want to take it. That's up to, really empowering consumers to make more informed decisions about their health. And that's really where the longevity game comes into play.
So correct me if I'm wrong then. This kind of wins for everyone. This is a win for the carrier, and it's a win for the client too, because we're getting more screenings for us personally and getting better answers to our health.
And you can even take it further than that, I think, right? Like you would take it even to the financial professional that made the recommendation to go with, in this example, John Hancock, because they want their clients to live longer, healthier lives just as well. And, think about it just rather almost selfishly, right? Like if Eric was my client, I provided him a John Hancock solution that gave him access to detecting his cancer early. there is likely very little situation where Eric is now going to leave my practice, or perhaps his family is going to leave my practice, right? Because I have illustrated to that consumer, not only am I interested in protecting your financial well-being and providing you the protection you need there, your family's health and longevity is critical to my business too, right? It's that shows that you care aspect beyond just I'm in it for the commission, which I think a lot of people rather cynically look at the financial services world is as they think, oh, it's a salesperson. And it is more than that, right? Every single advisor who might be listening to this understands that the relationship that they have with their client and the client's family is really, that's the business. The product that they sell is just a tool that they're using to help that family.
Right. Exactly.
Completely.
Well said.
Yeah. So I guess then this might be a dumb question to ask, but these wearable devices and the screenings, are they making a difference?
I mean, the short answer is, I think, functionally, yes. Right. So I already gave you a couple examples with Gallery, and, we actually have an example. It actually ends up being a financial planner himself, ended up having a Apple Watch, younger individual, noticed that his heart rate was way higher than he thought it should have been, ended up actually getting diagnosed with a cardiac condition and ended up going in for surgery. Now, we would never draw a straight line to specifically John Hancock in that example, but it's using things like that type of technology. So, again, using Apple Watch. Apple Watch also has fall detection, right? My father-in-law isn't particularly well, but one of the things that we provided him this past Christmas was an Apple Watch. One, so he has a general sense of how much he's moving, but also quite honestly, if he has a fall, he's a larger gentleman. My mother-in-law is fairly petite. She's not going to be able to get him up off the floor. It can do the fall detection and also link straight to his cell phone and be able to call for potentially emergency services. So there's lots of things. Don't think about this type of technology it's just like the Fitbit that,
step counter.
They're running, they're walking laps at the mall, right?
Closing their circles. Yeah.
No, I completely agree. I mean, I'll use myself as an example. I have a Garmin, and the sleep pattern that it tracks for me, it made me aware of my habits, if that makes sense. I started getting better sleep because I started paying attention to it more. I knew I did something about things.
Well, it goes to one of my absolute favorite quotes. It's Peter Drucker. He's a fantastic academic, and he's like, "You can't improve what you don't measure." Right? If you don't know, you don't know. Right? You don't know if you're getting better. Same reason why, okay, you want to lose weight, awesome, but if you don't know where your starting point is, how do you know that you're doing it? Or you want to improve your blood pressure, you don't know what that actually is and looks like. There's a lot more to it than it appears to be on the face.
Correct.
Makes sense.
So why, or I guess how is all this important for financial planning, specifically insurance?
Yeah. So let's go in a little bit specifically, right? So LIMRA does their barometer report every year. So actually in their 2024 report, it actually goes into some of this a little bit specifically. So generally speaking, they're leveraging this type of data and things like wearable devices into two kind of broad programs, active and passive sharing. So active sharing, as the name suggests, is one that requires a specific action to be taken to get credit for those behaviors. So for example, getting your flu shot or going to the gym might require you to snap a picture of your Walgreens receipt, or getting some sort of attendance listing from your gym for the days that you went. Whereas passive involves passively sharing data, such that fitness device. So linking your fitness device like an Apple Watch or Whoop to a Fitbit to provide that passive data coming over there. Now, what's really interesting here, the LIMRA report suggests that the consumers who are interested in these types of programs, 60% cite that a discount on the premium by illustrating those behaviors is the top reason for choosing to participate in those types of things. Now, as far as passive programs, it's nearly 7 in 10 that cite their interest in utilization. Now, This is part of the reason that we created John Hancock Vitality, because we actually do it as both passive and inactive. So we actually have the ability to link wearable devices into the program to get credit for the things that you're doing to be physically active. But we also have, the mobile app and the website to literally snap a photo of your Walgreens receipt from your flu shot. Or, oh, you went to the dentist, let's get you credit for that. Or you used a meditation app like Headspace, or you got a good night's sleep, getting credit from that from your Garmin, as you used as the example earlier. You get credit for that.
Wait, you can get credit for a good night's sleep?
Yeah, so you can literally reduce. Look at this. You can potentially reduce your premium outlay by going to bed, right? But we all know sleep is really critical to the holistic view of what health is and means. So that's really, I think, where leaning into carriers that have programs like this and tying that into the insurance need is important. But as I indicated previously, it also allows the financial planner or the financial professional that's involved in that space to now have the conversation potentially about the insurance planning that is more around them living well and longer and better versus, okay, Eric, so you're going to die at some point. How do we protect your family from that? It's a harsh reality. But it's not a pleasant conversation to have. So an advisor can shift it, right? It allows them to shift the conversation. Yeah. It allows them to have potentially a competitive differentiation around their peers, and it allows them to really exhibit their practice a little bit more holistic in their approach than just, okay, you have a mortgage that's 30 years. Let's make sure that you have a 30-year term policy in place to make sure that's there. Yes, absolutely. That I don't want to diminish the importance of that type of protection. But if you can wrap a little bit more of a holistic approach to that client and that family, it really makes the financial conversation a lot easier.
Oh, it makes total sense. Plus, I mean, the client can sit there and actually be rewarded for the behavior that they're taking, whether they want to, I guess, does it fluctuate on how often they participate? If not, I'm assuming more participation, greater savings. What if there's no participation?
So, and that's actually, you bring up a really good point, and you use the word rewarded. So the whole concept behind programs like this, like John Hancock Vitality, are meant to be carrots, not sticks. So if you choose not to participate, your policy is going to perform minus the rider charge for Vitality, which is $2 a month on permanent, exactly the same way as a policy without Vitality. It's if you do choose to participate, the more you choose to participate, the greater that differentiation really becomes.
Okay. So you're not penalized, but you're just rewarded for participating.
Yeah. And nothing about the program is compulsory. I think that's also really important to understand too. You can pick and choose which aspects are either of interest or you're willing to do. So I always use my mother as the example. My mother does not like wearing anything on her wrist. Be it a Fitbit, be it a bracelet, nothing. So she actually, on her Vitality policy, she can participate through other avenues of the program, right? She can do it through her regular screening that she gets at her doctor. She can get credit for her mammogram. She can get credit for, the fruits and vegetables she buys at the grocery store. So there's things like that you can just choose which parts are of interest to you, or if you're not willing to share that information and you don't have to, then okay, that's fine. You just don't get credit for that part of the program because I can't give you credit for what I don't know.
Right.
Makes sense. So correct me if I'm wrong then. This all sounds like it's intersecting. It's a function of insurance, health and longevity. Am I correct in thinking that or seeing it?
No, I think that's really a way to rather just pragmatically look at it, right? It's a real shift, right? So, and I think it's important to also look at it. I think a lot of people are probably thinking about this is this an evolution of underwriting? And I think the short answer here is I would argue potentially, yes, it is, right? You wouldn't offer a client who doesn't smoke a policy that doesn't give them a distinction between a smoker and a non-smoker. Same thing when the advent of gender distinct rates. Right. You wouldn't issue a customer a policy that's not distinctive enough of that. Leveraging concepts of, even when preferred risk classes came out, right? That's similar narrative exists there. this is just another way to kind of create a differentiation between that. So I think it's understanding that, let's go back down to the consumer, right? Consumers, when they think about insurance, they think about it through the lens of it's an average. So I'll use myself as the example. I'll be put into a risk pool of 45-year-old non-smoking men. Together, we just pay the premium of the average 45-year-old non-smoking man. It's the way it works.
Right.
Mm-hmm. But what solutions like Vitality does, it allows the consumer to say, hey, John Hancock, I'm not the worst risk. I'm not the average risk. I can prove it to you through these passive and active programs. And subsequently, I want you to differentiate my policy's performance because of the things that I'm doing differently. And if it's functionally no different than that, I don't think you need to overcomplicate the bigger narrative into, oh, well, if you take 11,242 steps on the second Thursday of March, like it's a lot bigger than that. 100%.
Right. Yeah.
Awesome.
So Matt, what does all this mean for the future, and what are you guys currently seeing with all the data that you guys are getting?
Yeah, so let's kind of answer that in reverse order, because I think, again, starting where we are today and where we think it's going, right? So I think what's really interesting is we have really high utilization and election of what we're doing. So I think, again, pragmatically, it just makes a lot of sense to do this, particularly if it's carrot, not stick. But what's really interesting is that we're actually seeing it start to create these leading indicators for longer term positive health change. You know, we launched Vitality in April of 2015, so we're coming up on 10 years. Now, I would never say we've shifted and really made a hard turn on the mortality corner on that, because 10 years, it's not that big of a period of time when it comes to looking at mortality shift. But from like a leading indicator perspective, if we look at, because we don't get individual data, we only get it actually at the population level. So if we actually look at it for consumers who have room to improve, like, so if you don't have a in range or a healthy cholesterol reading, for example, we've actually seen if they had a reading in 2022 and 2023, 32% actually showed an improvement into a healthy range. So the folks that had room to improve, the ones that we want to see improve, are actually showing improvement. We saw similar with 44% of folks with elevated blood pressure, bringing it into a healthier range, 40% of those with elevated blood glucose, bringing it into a healthy range. And, you know, taking some of those, and don't get stuck in the details of like, oh, this is what this means for blood glucose, this is what it means for blood pressure. You'd even take it at a higher level. One of the things in the program is that it asks an annual survey, like, how do you feel about your health and things like that. 82% have indicated that they either have better or similar health year over year from 22 to 23, year 22 to 23. Now, what's interesting there is if you understand how insurance works over time, right? Like from an actuarial perspective, I'm not an FSA, so I'm not going to get super technical here. But generally speaking, there's a certain set of assumptions. So if you have 1,000 preferred non-smokers, 10 years from now, you don't have 1,000 preferred non-smokers anymore. A certain number of them have fallen outside of the preferred range. But again, 82% seeing similar or improved health year over year, it's kind of flying a little bit in the face of that, at lack of better word, decaying health of the population at large. You're actually seeing that stay a little bit more level and a little bit more either potentially increasing in that. So that's, I think, really important to understand where we are today and kind of where we're seeing it start to go. Now, really future thinking, and actually probably not too far in the future, I would expect to see more, not just from John Hancock. Obviously, we've evolved the program continually over time. You know, it is a part of the policy contract, and we have added more and more to the program. Like, you know, we didn't have the gallery test, we've added that. We didn't have our relationship with Prenuvo, which is a whole body MRI, that we've added a benefit within the program within that. But you're starting to see it come to life also with some other carriers as well. Now, I wouldn't be a good John Hancock person if I named any of them by name. I'll leave that to our friends here at CBS. But other carriers are looking at how can they integrate things like Grail. Now, candidly, I welcome them to the pool. The water's fine. Come on in. But of course, I also view Vitality as a bit more holistic and robust that does more because there's a premium benefit, there's a policy enhancement that can exist in there. It does more than simply provide access to things like Gallery. I think it's a great first step that a lot of the other carriers are doing, but I welcome them to lean into that even more.
So how does all of this affect demographics differently from a longevity perspective?
So that's interesting, right? Because there's different aspects to all of this that hit different demographics differently. Well, I use the word differently a lot in that statement, but that's
a
okay.
Loaded question.
We're talking about a pretty broad group of people. Obviously, I think what's interesting is when you think about people thinking about living longer, right? Your brain naturally is going to go to like, okay, I'm thinking about maybe my parents that are in their mid to late 70s, or maybe even a grandparent if they're still alive in their 90s, perhaps. And I think that is, yes, a part of it. The harsh reality that their own mortality is a little bit more front and present of mind for them is true. But you are seeing more and more kind of interest in things that are health related and longevity related across all age demographics. But the common theme here is that we all want to live longer, healthier, better lives, regardless if you're 80 or if you're in your 30s, right? And you see it kind of across the board also from incomes as well. Now, of course, higher net worth individuals have more disposable income. Actually, the Global Wellness Institute cites that in the US, it's about $1.7 trillion are spent in the wellness economy in the United States. So they just released a report earlier this year that goes with it. It represents almost 7% of the US GDP.
Wow.
It's a huge amount of money that consumers across the board are spending. Now, of course, higher net worth individuals have a little bit more disposable income to afford them things like that. Now, that's where you'll see things like medical tourism, where, okay, I'm going to, while I might live in Texas, I'm going to fly to the best Cleveland clinic over here, or, oh, I have a particular health condition, but there's this surgeon in LA that's amazing at it. They'll go and travel to that. And it might not be specifically for a certain condition. It might be flying to a Prenuvo location because they want to do a full body, whole body MRI and do it that way, right? So there's lots of different things you can do and see. And, and medical tourism is a much bigger kind of cerebral concept, but it really underscores the fact that like your consumers are spending a lot of their dollars, roughly 7%, right, on these types of things. Why wouldn't you want the financial solutions that you're putting forward to them align with their own priorities, right? Above and beyond the importance of the protection that you're putting into place, but you can align that solution around things that they've already clearly illustrated that are priorities to them because they're using their dollars to vote.
Very well said.
Yeah. Matt, fascinating stuff. I mean, I think it all sounds like, I guess it's safe to say that the financial planning industry is really starting to evolve and, really grab onto the idea of living a longer, healthier life.
No, I completely agree. And I think it's interesting. I think, again, like at first look at it, I think the industry views it as like, okay, well, you know what? People are living longer. I don't want my clients to outlive their income. Here's an annuity solution. Yes, absolutely. But it is bigger than that, right? It goes into what can I bring to that consumer? Maybe it's in life insurance planning that's going to lean into this health and longevity piece that like ties in. Again, it brings it into a more of a holistic look, right? And I don't have to tell you, or probably also a lot of the folks that are listening to this, is that you're seeing a shift in planning, right? You're seeing fewer insurance-only planners and a greater diversity in folks that insurance is part of their business, but also other aspects are part of it. They're taking the more holistic view of the finances of that client or that family, but now bringing in things like longevity into it actually wraps another level of holistic planning to that family as well. So it's really exciting to see the industry really start to come around the corner on this. Not only because I've been working on this for the last 10 years and I'm excited to see it come forward a little selfishly, but Just again, just very matter of fact. I think it's the right thing to do. It's the right thing to do as a carrier. That's why we've brought it forward. And I think it really is the right thing to do as a planner when you think about that family.
I could not agree more. And I like the way that you mentioned it. It's that segue that it's not just planning. It's not just numbers anymore. It's that full on holistic view. It's about the client and their health and their ongoing health. Matt, thank you so much for taking the time to speak with us today. Do you have any closing comments for the audience?
Well, first, thank you both. It was really exciting. I mean, I hope that my passion for this really kind of comes through. Now, for everyone else, I'm good. I think, for everyone else, I think the big thing I would think about is understand what I alluded to before, right? Like, what we're doing at John Hancock is what we're doing today. It wasn't what we were exactly doing the exact same thing even 5 years ago. And what it means in the future is also going to continue to evolve. And one of the great things about what we've done with Vitality to deliver that kind of longevity solution is that whatever we add to the program is also added to existing clients as well as new.
Oh,
and it really has afforded us a great opportunity to establish some really great relationships with leaders in the space, right? Like we regularly have interfaces with folks at Google Health and Apple and similar. So we actually are really plugged in to what's happening there. And you'll see more from us, even just from an educational perspective, leaning into that as well.
So it's all just beginning now. It's not we're nowhere close to the end.
Never.
Well, I love it. Well, thank you very, very much, Matt. For everyone else out there, I am Michael Kohrmann.
And I'm Eric Alvarado.
And this has been CBS Spotlight, your friendly conversation about insurance and wealth advising come together. So thank you again for tuning in. Don't forget to like and subscribe if you find this helpful, and we'll see you all next time.